battling the relentlessly negative doom and gloom news media. It's the Nick Stenger Show, coming to you live from the Stenger Family Office headquarters. It's your host, Nick Stenger.
All right, ladies and gentlemen, welcome back to the Nick Stenger Show. My name is Nick Stenger. We are the Stenger Family Office for the past 42 long years. It's been our mission to deliver both clarity and confidence to help secure your financial future. Welcome back. Episode 134, Burns versus Volcker. Burns or Volcker is the title of this week's article and show. I apologize for getting this out to you late. This is a Monday as I'm recording. Should have the show out to you recorded on YouTube, Spotify, Apple, and won't keep you waiting any longer. We had a busy week last week. I was down in Nashville for a conference, an investment conference that's great every single year. We'll tell you more about that in Investor Day. Don't miss it. It's this week, November 14th and 15th, Tuesday and Wednesday, literally coming up tomorrow night with a kickoff dinner at Sullivan's. That is completely maxed out. And Wednesday, we do have our half day of speakers. You got to be there. You have to be there. We put in a ton of work this weekend to make it top notch for you. So come out Wednesday, starting at 8 a.m. We've got a breakfast, presentations, we've got lunch, we've got guest speakers. You cannot miss it. That's our Investor Day. We tell you about our portfolio management, rebalance, and due diligence process that is so important. I can't tell you how many people are coming in with these portfolios right now that are underwater. These are prospective clients coming to Stenger Family Office that have been referred over or who have heard about us. And they're saying, Nick, how come I haven't made any money with my advisor for 2 or 3 years now? And we literally last night I got somebody like this. We looked at their portfolio, and it turns out they've been sitting on 40% international, 30% in long-term bonds. And I won't name the name of the firm, but this is one of the biggest firms on Wall Street. You would know it if you saw it. One of the most popular names out there for Wall Street wealth management, as far as that's concerned. And this is one of those third-party outsourced portfolios that the firm is managing in New York City. And these are supposedly the experts, the top people, the PhDs and CFAs and all that stuff. Well, despite all that paper knowledge, they did not use common sense or critical thinking. They were buying long-term bonds at the beginning of the year, which we said to avoid. They've been buying international stocks for the past 3 or 4 years. And it's a mess. It's just a complete mess. And this is what we've warned you about. So you go, Nick, how come you in Naperville, Illinois here, you and your firm here, how come you guys knew not to do that? Well, it's just common sense. It's critical thinking. And there's no magic mousetrap we have, but we have stuck to our principles. And our principles have been that we want to own blue chip U.S. companies run by the best entrepreneurs on earth. And thanks to a lot of the third-party research that we do, we're able to get sort of a compilation of all the different opinions out there, all the different things that the top analysts are thinking, the top pundits are thinking, and then we're able to make a final decision. And a lot of times we're contrarian. We actually go against the grain. We may hear from 25 asset managers to do something, and at the end of it, my partner Bon and I and the rest of our investment committee, we may say, no, we're going to go the opposite way, or at a minimum, not do what these 25 people are recommending. Because sometimes when you go with the herd, you don't realize, but you're actually about to jump off a cliff. And that's the same thing that happened during COVID with interest rates and Janet Yellen calling interest rates and inflation transitory. And that was such a mistake. And so how did we know that inflation would not be transitory? Well, some of the third-party research, one of the guest speakers is with the firm First Trust Portfolios. It's coming in on Wednesday to do a presentation. That's why you can't miss it. They were instrumental in telling us that inflation would not be transitory. In fact, they were one of the lone voices in the wilderness saying, don't buy long-term bonds, that inflation's not transitory, and that inflation would be going higher. And sure enough, they were right. And we like that. We like when there's one lone voice in the wilderness saying, be careful on something, or be bullish on the other side of things when everybody's nervous and negative and down in the dumps, like at the end of last year. And I would argue largely to an extent this year as well. Nobody thought that the market would be up 15, 16% the past 12 months. But it is. And how did we know that? How did we think that stocks were going to go up? Well, again, we followed our disciplined rebalancing process, not a magic formula or anything like that. And it doesn't always guarantee you're going to make money. Obviously, it doesn't guarantee that you're not going to lose money in a declining market. But what it does do is it keeps you on a disciplined process. And if you're going to be an investor, you have to have consistent discipline in the markets. You can't be going off of emotion and buying and selling and reading the most recent doom and gloom news story and panicking. That's such a mistake. You got to just stay on the plan. When things get cheap, buy more. When things get expensive, sell some, take some profits. So I would encourage you to do the same thing. We'll jump into this week's article, but before we do, just 3 quick stories we're watching for you here. The U.S. debt downgrade, consumer spending, the Fed outlook, and where they're going to go with interest rates. This whole article this week and show is about the Fed. I know I've been talking about the Fed quite a bit on these weekly shows, so I don't mean to beat a dead horse, but the reality is that the Fed really does control a lot of what goes on from a valuation standpoint. When you're a good company that's managed well conservatively, you don't have debt on your balance sheet, or you have very little, you have plenty of assets to cover that debt, you're growing, you're profitable, perhaps you're in a business that happens to be have a high degree of operating leverage, so that when your revenues go up, your profits go up even more than your revenues from a percentage standpoint. There's companies like that are making it through this cycle totally fine. And I'm actually going to show a slide at Investor Day on Wednesday in my presentation, brand new keynote called 8 Bags of Gold. We'll have the recording. If you're out of state, we'll send you the recording if you want it. And also subscribe to our YouTube channel, subscribe to Spotify and Apple, because we'll put it out there. We'll put it on YouTube. You can watch it a couple weeks after the event on Wednesday. But there's a great chart from the beginning of this year. If you look at S&P 500, which is the cap weighted, that means the top stocks rise to the top. They get bigger as a part of the index, versus just the equal weight S&P. So it's the exact same holdings, but the equal weight, it's in the name, they equal weight all the holdings. So even the bottom stocks in the index are weighted the same as Apple, Microsoft, Amazon, Netflix, and Google. That's only up about 1% for 2023. The S&P 500 index is up about 16%. And that's a phenomenon that's been going on for a while. We pointed out, we said it's going to keep going. At the end of last year, if you remember our due diligence, we said the big will get bigger. That's how we positioned the portfolio. And the reason why is because not because, oh, it's such a horrible thing that the Magnificent Seven, which you've heard about, that the top stocks are getting bigger. That's not a terrible thing. It's just a reality of being an investor. It's just a fact of life. If you're going to own equities, the big companies will do better. And it's not that the little companies over time just don't do as well as the big companies. They literally go out of business. And if you look at the S&P 500, those companies that are barely hanging on by the seat of their pants at the bottom of the index, I believe a lot of them won't exist. A lot of them will actually be kicked out of the index because they will become mid caps. They'll become smaller, not bigger. That's a bad thing. And so do you want to own more of those ones at the bottom or less? My opinion is you should own less of them and more of the stocks at the top. So that's what we've done with the portfolio. It's worked out very well. One quick note on that though, okay, is if you look at that chart, again, I'll show it to you on Wednesday. We'll have it in the replay. Those two indices, the equal weight and the S&P cap weighted index, just the regular cap weighted, market cap, biggest go to the top, they tracked each other almost to a T up until March and really the early part of April. Ask yourself why that is. The reason why is because earnings started coming out in April. First quarter earnings for 2023 started coming out in April and May. And because of that, stocks, all of a sudden, people realized and investors realized, hey, there's a big difference in an inflationary environment between the top companies and the bottom companies. And on that chart, all of a sudden, those two numbers start diverging substantially, and the cap weighted really takes off. Starting in April, that's when cap weighted makes its rally. And so that's where you have to really pay attention, because I think the reality is, and the fact of the matter is that a lot of people look at the markets, they say, oh, it's just the market. It goes up, it goes down. It's a fagoozy, a wazi, a woozy. It's like Wolf of Wall Street. It's not real. It's fake. That's not true. The market is real. It's a collection of ownership in America's best companies, and fundamentals do matter. Stocks with good fundamentals, meaning good balance sheets, good earnings, growing revenues, growing profits, growing margins, shrinking their shares outstanding. That's called corporate buybacks, paying you dividends, and not just a high dividend, but a growing dividend. All of those factors really do matter. It's not that you just throw all your money in the market in every stock in 3,000 different companies and hope it works out. You are making an active decision anytime you buy stocks. Nobody is a passive investor. This is very important to understand. Nobody, and I mean nobody, is truly passive. You're either letting an index provider do it for you, or you're hiring a manager like us to do it for you. And at the end of the day, what happens is the big should be a bigger part of your portfolio, especially if you're retired. Now, if you're younger, if you're just starting out, if you're getting going, maybe you do some mid cap, maybe you do some small cap. And everybody says, Nick, look at the small caps. Over the long run, they do better. Well, maybe, but they also take on a lot more volatility. And I believe they face significant headwinds, rising interest rates, all the things that have gone on the past couple of years with COVID. I think not all of them, but a lot of them have mismanaged. They've bought too much inventory. They've hired too many people. They're in a predicament, quite frankly. And I do think there's going to be some massive problems with small caps, some issues with mid caps. And the point is that the large caps just continue to dominate. Look at Berkshire Hathaway, okay? $165 billion, $165 billion with a B on their balance sheet, earning 5% risk-free in treasuries. Warren talks about it all the time. That's roughly $9 billion in interest that goes directly to their bottom line that did not exist 3 years ago. Now, is it durable? Will it last forever? Probably not. Interest rates will come down. So we don't factor that into how we buy Berkshire stock, which we do own it, by the way, have owned it for a while. But more importantly, what it shows is that $9 billion that Berkshire earns in interest alone on their cash, on their balance sheet, is more than the revenue of the largest mid-cap stock in the S&P 400. That's a crazy concept. That really has not existed for a long time. So this is the issue. This is where we see opportunities. Stay in the large caps, stay in the best names. They will make it through. Some of the small caps and mid caps will make it through, but I just don't know if I would take on excessive risk to hope and pray that it works out. So consumer spending dropped off a little bit. Debt downgrade, I'm not worried about it. We've downgraded the U.S. debt before. This came out over the weekend. Moody's said, and technically not even a downgrade, but they just said the outlook is a little bit less certain. The market, I'm pulling it up right now. It is 8:34 a.m. Central Time. Market just opened. Stocks are down about 40 basis points. It's not the end of the world. And we predicted this in the past. These debt downgrades, they're not great. We obviously don't love to see this, so don't get me wrong. But it's not the doom and gloom scenario that would cause you to want to sell stocks. And so number two, same thing, consumer spending. Don't sell stocks because consumer spending is weakening. What I would do, though, is just tighten your belt, tighten your wallet. Don't go out as much. Don't spend money on stuff you don't really need right now. I've been saying delay car purchases, delay home purchases. Be careful over the holiday season. Don't blow your budget way out because we are going to have layoffs. I'm telling you it's coming. We are going to have layoffs, and I'm not rooting for this, but it is coming. I think probably next year. I could be wrong on the timing, maybe 2025. So just be careful. This is not a negative for the equity market. In fact, it's a positive. Again, we're not rooting for this, but it's just part of the economy. We go through cycles. We have record low unemployment for years now. There's plenty of unfilled jobs still. But I do think we are going to have a little bit of a slowdown with the labor market. Okay, Burns or Volcker? That's the title of this week's article. I pointed this out last week, and I tried to make it as clear as possible that during the 70s, the market really panicked way in advance of the downside of Volcker, who came in, was really, really hawkish. He raised rates very quickly to very high levels in the early 80s. But see, if you tried to sell equities right when he started raising rates, you actually would have lost money. You would have been better off staying in your stocks because all the bad news had gotten priced in the 70s when a guy named Arthur Burns was the Fed chair. He was the Fed chair. Burns was the Fed chair before Volcker. And so I think basically the point of what we're trying to say here in this article is that Burns allowed inflation to kind of come back and get hot. Volcker did not. And so at the time, Burns was loved. And in the 70s, people actually liked Burns quite a bit. Now, the history books look back on him very unfavorably. They're not happy with him. They think he made a huge mistake. Volcker was the opposite. And so Volcker in the 80s was hated, but today he's looked back upon very fondly. And I just think about Michael Scott in the show The Office, who said, "Would I rather be loved or feared?" And he said, "I want people to be afraid of how much they love me." That's what Powell wants as his legacy. He wants to really get us to a soft landing. He wants to have his cake and eat it too, and have raised rates, slowed down inflation, fixed the inflation problem so he can be loved, but then also not cause a massive recession, this hard landing we keep hearing about. I already think, and I'm not saying we had a massive recession last year, but I actually think we had a mild recession last year that went somewhat unnoticed. There was a small change in definition of what people called a recession last year. But the reality is we did have slowing GDP. We didn't have a tick up in unemployment, but I almost think we had sort of a stealth recession. That's why the market was down about 22% in 2022. In anticipation of bad things to come. So when everybody says, Nick, how could the market be up 14 or 15% this year? How could big tech be up 50, 60%? We got to remember all those stocks last year in 2022 sold off 30, 40, 50%. They're just starting now to make some recovery. So it's not like there's this massive bullish sign in the market. There's not this massive sign to the upside that everything's great. There's a ton of bears out there still. There's a ton of people who are scared to death of Powell, as they should be. You should always be scared of the Fed chair because they control everything. It's centralized planning. It's a one world government. And I know that sounds like conspiracy, but this is what Karl Marx said. Karl Marx said, basically, centralized banking is the entire backbone on what communism and socialism rely. So you cannot have socialism, communism, Marxism, unless you've got control of people's money. And the biggest problem with central banking is it does through the back door what cannot be done through the front door of policy. A politician back before the Federal Reserve came into existence in 1913, if they wanted to pass some sort of spending or do something differently with policy, would actually have to pass a bill in Congress to make that happen. Well, that's changed. And so today, if you want to pass policy, you want to do the Green New Deal, or you want to do the Great Society or the Great Reset, or whatever it might be, like LBJ did back in the 60s or in the 50s and all that stuff. And then FDR did coming out of the Great Depression. All of that stuff was not financed with new taxes. Some of it was. Don't get me wrong. Some of it was, but not all of it. Most of it was paid for by deflating the money supply. And so you say, hey, we're going to spend $2 trillion on the American Rescue Plan. We're going to spend $1.5 trillion on the CARES Act. And remember, that happened under a Republican and a Democrat. And so it's this bipartisan thing where if you just wave your magic wand, money appears and policy is put into effect. You could never do that in Congress. If the Congress people had to actually go to their constituency and say, we're going to raise your taxes to pay for the Green New Deal. And I'm sorry, I'm saying that one a lot, not picking on it, but that's just one that's been talked about recently. If you had to go to your voting base and say, hey, we're going to raise your taxes to pay for something that, we're going to have put windmills in Kansas, people would never go for it. They'd say, what are you talking about? We're not going to do that. That's crazy. But if you inflate their money slowly over time, you basically tax them. Inflation's a hidden tax. Okay, Thomas Sowell's talked about it. If you don't read Thomas Sowell, you better find out about him and quickly. If you don't read Milton Friedman, find out about him quickly. Okay, all these guys talked about it. So okay. By the way, Canada, okay, has a person running for prime minister that is quoting Milton Friedman. It's unbelievable. Okay, so this is the reality: is that centralized banking allows you to go through the back door and tax people on their hard-earned cash. And that's why, and I'm going to talk about it on Wednesday, that's why you really want to be there, watch the replay. A Big Mac in the 70s cost like 36 cents. Okay, today it's $5.50 is the average. Okay, Toyota Camry used to be a couple $1,000, $3,000, something like that. You probably can't walk out the dealership here in Illinois for less than $35,000 on that same Camry right now. Look at COVID the past couple of years. We've gone from a house being about $320,000, maybe even a little bit less was the median, 2019, at a 4%, 3.5% interest rate. Today, we're now sitting on the same house being worth roughly $50,000 with an 8% mortgage. Okay, there's no free lunch. Oh, here we're gonna pass all these bills. We're gonna give you all this free money. We're gonna pay you to stay home and not work. Here's your free money. Here's your COVID checks. Here's all this stuff. Okay, well, guess what? The bill is coming due. You cannot have free money forever. At some point, the value of the new dollars printed into the economy are incrementally worth less each time you do that. And that's what happens in a communist society. So you go, Nick, how can you say that communism and Marxism always go hand in glove with centralized banking? Well, just look at Venezuela. Look at all these places who have done this. They've turned once rich societies, once very prosperous societies, and they've gutted them. And they've taken away people's cash and they've taken away their money. Not overtly, they haven't come into sometimes they have, but they haven't necessarily come into people's houses and taken their money away. But the money's become worthless because they've inflated it beyond recognition. So anyways, I'll move on, but just be careful with the central banking stuff. I know Powell's not watching this, but and look, I will say another thing. It's not all his fault. And despite Burns being hated and loved and Powell being hated and loved and Volcker being hated and loved, doesn't matter. These guys are dealing with the fact that politicians have put them in this mess. Now, they are supposed to be the backbone. They're supposed to be the backstop in theory, but that was never the intention. And that's my point of it. And maybe you say that gets into the, maybe the tinfoil hat thing. Okay. But that was never the intention. And if you read the kind of beginnings of the Federal Reserve, they didn't even want to call it a central bank because they thought it sounded too Marxist. Okay, I'm telling you, this is all history you can read. And so then they came up with the term the Federal Reserve System, and they said we'll have these 12 banks and they'll all vote and it'll seem really democratic, but it's not. There's one guy at the top who votes for it all. So okay, let's talk about how to deal with that. And I do want to just mention the politicians. Okay, let's just talk politicians wise what happened here. LBJ years, print and spend years. Nixon was no better. Nixon abandoned the gold standard. Then you had Gerald Ford, who for a short time declared inflation public enemy number one. That was a couple of good years there. And I'm not saying right or left is, I'm not taking a side, but I'm just telling you from a policy standpoint what hurt us with inflation versus helped us. Jimmy Carter came in and he returned to the disastrous LBJ style policy. He increased the size of the federal government. If you fast forward to the modern era and you fast forward to the year 2000, President Bush, okay, he was one of the worst presidents when it came to fiscal responsibility. Okay, he bailed out the big banks. He bailed out the auto companies, right? And Obama was no better, okay? And actually Obama printed money to the tune less than Bush did. Okay, so this is not just the left versus right. It's both sides. They all love the magic wand. It's like the ring from the Lord of the Rings. You put the ring on and you don't, you think you don't have inflation, but then guess what happens? You got to take the ring off and all the inflation comes right back. There's no getting away from just basic fiscal responsibility. Now, Ronald Reagan, and I'm not saying he was perfect. I'm not saying he ran a perfect budget. He obviously increased deficits. Okay, we all know that. However, Ronald Reagan put in place a series of policies that helped us to start paying down the debt in the 80s. And so we had 8 years where we had, yes, big deficits, but we paid down the debt. Bill Clinton was forced, and he had some good policy, but he was forced to work with the Republican Congress and had to keep paying down the debt. I think we're in the same position today. So you think, Nick, how are we going to deal with all this runaway inflation, all this runaway print and spend, and all the runaway government debt? Well, eventually it will get so bad to the point where Congress will have to act. It'll get so bad that they will have to raise taxes, and it will be unpopular politically. And to not get themselves voted out of office, they will have to adjust. They're going to have to cut spending. And in politics and life and economics, there's a big pendulum that swings. Human nature's square in the middle, and things just kind of like rotate. So we go to one extreme on the left sometimes, then we go to one extreme on the right, but eventually that pendulum swings. Right now it's sort of off to the left, and it's going to slowly swing, I believe, back to the right. It's going to go back towards the middle. May not get there completely, But I do believe, thanks to our founders, how they set up our country, we will have to get back to common sense. And I believe that we are going to have a little bit more gridlock in Washington next year in the next election. So I believe we focus way too much, and I'm subject to this as well because we have to. We focus way too much on monetary policy, not enough on fiscal policy. The Fed would have a far easier job or not even need a job at all if the politicians delivered balanced budgets and smaller government. Whether you're left, right, center, Green Party, whatever you are, you should want smaller government because the bigger and bigger government gets, the more and more individuals get crushed. 1984, George Orwell, he wasn't even a right winger, okay? George Orwell was sort of like a libertarian, or even some people thought he was very liberal. And even he pointed out the fact that the bigger government gets, the more it crushes. It used to happen with the right. When the right was the ruling class and the elite, they used to silence the left, and that's how you ended up with UC Berkeley and the birthplace of free speech. Today, it's kind of changed, and that's where it gets into that pendulum. Today, the left is the elite, and they're the ruling class, and so now they're sort of crushing the right. They're crushing individuals. And so what we should all want, whatever side you're on, you just have to ask yourself, if I was on the other side of this, would I want this? Would I want to be silencing free speech? Would I want to be silencing my opposition? Would I want to be throwing my opponents in prison? All of that kind of stuff, because eventually it can come back around. It can come back around and bite you in the butt. It's happened plenty of times in history, and I do think people are starting to wake up to some of this stuff. So the main thing is we got to get fiscal responsibility. We got to get balanced budgets. We got to get people to start voting with their wallets. We got to have common sense. We cannot live in a world with 8% mortgages forever when a house costs $477,000. Everybody says, oh, Nick, I paid a 10% mortgage or a 12% mortgage. Yeah, that's back when, a house was $30,000 or $25,000. We're not in that world anymore. And I'm telling you, I'm in this generation where I watch people that I went to college with, or that are older than me, they're younger than me, they're just coming out of college. And I'm telling you, they've got a tough road ahead. And what we need to do is we need to give them a stable currency. The best thing you can ever do for the next generation is give them stable monetary policy, that your dollar today will be what it's worth in 5 years or 10 years or 15 years. Now, how do you deal with the reality? How do you get around it? So if you're millennial, this applies to everybody. If you're boomer, millennial, wardrobe, whatever you are, you have to be in the equity market. I keep saying this every week. You go, Nick, I'm going to go buy a 5% risk-free money market right now. I'll never have to deal with stock market volatility again. That is the biggest mistake you can make, because that quoted yield, that 5%, is a nominal rate of return. That means before inflation, yes, you are getting 5%. But if inflation is 3%, which it's higher than that, but let's just say it's 3 for just simple math purposes, your real yield, your net yield, is 2%. What are you going to do with 2%? Nothing. After you get done paying taxes, you're not going to even be able to feed yourself. So what you have to do is look at equities where there's no guarantees, there's volatility, and that's the price we pay to own those equities, is the volatility itself. But the fact of the matter is that equities over time, like Dr. Jeremy Siegel have pointed out, a bunch of other people, is that equities compound to the tune of 8 to 10% per year. Why? Because they raise their prices. If you're McDonald's, what do? Your labor goes up 10 or 15%. Your burger meat goes up 10 or 15%. The buns, everything goes up 10 or 15%. Your rent, whatever it is. Well, guess what? You just raise your prices 10 or 15%. That's exactly what they've done. That's why the Big Mac used to cost 35 cents. Now it costs $5.50. And you're going, hey, if I'm an equity holder in McDonald's, my Big Mac, when I go to McDonald's, costs me a lot more than it used to. But as an equity holder, my dividends are higher than they used to be. The buybacks are higher. My stock price is through the roof. So I've been able to maintain my purchasing power. The only way you're going to maintain purchasing power is not through 5% treasuries, not through bonds, not through real estate, not through gold and silver and all that nonsense and Bitcoin, but through equities, which have pricing power. So the 8 to 10% that you're getting nominal on stocks, after inflation, let's just say it's only 8. After inflation, 3%, you're getting 5. So you go, Nick, 2 versus 5. Okay, I get the math, but I get the 2 risk-free. Guess what? You can't eat risk-free returns okay, or risk adjusted returns for dinner. You have to have your actual return, your absolute return. And so if you take the 8 minus the 3, you got 5% real return on stocks versus 2% on treasuries. You have to be in the equity market. And I'm not telling you to take everything and dump it in if you're 90 years old or 85 or 80. I'm not telling you that at all. You have to be on a goals-based plan where you've got some short-term treasuries blended in to cover a few years of living expenses. But you certainly cannot sell out of your equities completely and go to all cash. It's just not a good idea, and you will regret it over the long run. So yes, I get it. There's plenty of doom and gloom, plenty to be worried about, plenty to be nervous about. There's always been something to be nervous about, always something to be worried about. Don't let it throw you off your long-term plan. Thanks for being with us this week. Don't miss Investor Day. If you're not coming in person, we'll send you the replays in a few weeks, let you know what we did with the portfolio, and also give you a little bit of insight into the markets where we think things are headed. I do believe 12 months from today, the stock market will be higher than it is. So stay invested, stay optimistic. Don't miss Investor Day. And we'll see you next week for episode 135.